Ladies and gentlemen, Asian guy here. Stop what you're doing, put down the coffee, and understand this. You are standing inside a financial crime scene. Not a metaphor, not a theory. An actual, mechanical, forensic, fingerprints on the weapon crime scene. And the mainstream financial media is walking around it with blindfolds on, telling you everything is fine, that this is normal market behavior, that this is just volatility, that is gaslighting, that is narrative management. And what just happened in COMEX silver is nothing short of a financial assassination. We just witnessed 34 million ounces of silver go to delivery. Let me repeat that slowly. 34 million ounces. That is not paper. That is not some hedge fund spreadsheet fantasy. That is physical atoms being demanded from vaults that are already bleeding. And the moment that number hit the tape, the entire system started screaming in silence. The price did not react like a free market. The price did not behave like supply and demand. The price did not respond like any sane exchange would respond when one of its core commodities is being vacuumed out of the building. Instead, you saw what I call mechanical execution. The rigged casino flipping switches, deploying algorithmic V-shocks, suppressing signals, injecting hallucinations into the tape to keep you calm while the building is on fire. This is not a warning. This is the fire alarm. Because when 34 million ounces stand up and say deliver, that is not a trade. That is a run on the vault. That is a silent bank run. Only this time, the bank is the global silver market, and the depositors are not retail traders. They are industrial buyers, sovereign channels, and institutions that finally understand the paper game is finished. And while that is happening, CNBC is talking about rate cuts. Bloomberg is talking about AI optimism. Analysts are debating whether gold might go up 2% this quarter. That's not journalism. That's anesthesia. That's narrative sedation. They are putting the public to sleep while the core plumbing of the financial system is rupturing. You are watching the physical market divorce the paper market in real time. You are watching a rigged casino lose control of its dice. And you are being invited, not politely but urgently, to choose a side, digits or atoms. Because when metal leaves the vault, it does not come back. This is not 2020. This is not 2008. This is something new. This is structural failure. This is the point where paper derivatives collide with physical reality, and reality always wins. Every empire in history learns this lesson the same way. At the moment their accounting system breaks, the silver market is not tightening. It is not stressed. It is not imbalanced. It is failing delivery under a global industrial supercycle while pretending nothing is happening. And when the illusion finally cracks, not if, when, the repricing will not be gentle. It will be vertical. It will be violent. It will be remembered. So again, stop what you're doing, because what you are about to hear is not an investment thesis. It is a forensic reconstruction of a financial crime. And once you see it, you cannot unsee it. What you're watching right now in silver is not a market move. It is not emotional. It is not speculative. It is not even human. It is mechanical execution. This is the most important thing for you to understand, and it is the part CNBC and Bloomberg are structurally incapable of explaining. Because if they did, the illusion of price discovery collapses instantly. The silver chart you are looking at is not the result of buyers and sellers interacting. It is the result of pre-programmed algorithmic shock systems that fire in response to stress inside the derivatives complex. When pressure builds in the physical layer, the paper layer does not negotiate. It attacks. That is what those violent V-shaped moves are. They are not volatility. They are control pulses. They exist for one reason: to convince you the market is liquid while the vault is emptying. When 34 million ounces stand for delivery, the correct reaction in any honest market would be a vertical repricing of silver. That did not happen. Instead, what you saw was suppression, whipsaws, fake breakouts, fake breakdowns, and 1,000 micro-manipulations layered on top of each other so fast your brain registers noise instead of the signal. The system is under stress. Bloomberg calls this order flow dynamics. CNBC calls it profit-taking. Both are lying. This is mechanical reality versus mainstream hallucination. Here is how the machine works. Every major precious metals exchange is dominated by a derivative structure that dwarfs the physical supply by multiples that should terrify you. For every ounce of silver that exists in a vault, there are dozens, sometimes hundreds, of paper claims that say they own it. The system functions only as long as almost nobody ever asks for delivery. The moment people do, the system panics. But the panic is not visible to you. It is buried in the back end, in clearing operations, margin requirements, overnight repo, collateral substitution, and emergency liquidity windows that never make the headlines. Instead, the visible layer, the price, becomes a weapon. And they slam it, they spoof it, they wash it, they flip it, all to create the illusion that the market is calm, functional, and liquid. This is why you see silver fall on days when physical demand is exploding. This is why you see gold stall when vaults are draining. This is why the chart looks insane, because it is not a market. It is a control system. The mainstream narrative tells you high rates are bearish for metals. Dollar strength suppresses gold. Recession fears reduce industrial demand. These are ghost signals. They are after-the-fact excuses applied to mechanical outcomes. The real driver is this. The derivative engine is choking on its own leverage, and every time the pressure rises, the machine responds the same way. Crush price, trigger stops, flush weak hands, harvest liquidity, reset the board. Not because the market says so, because the algorithm is programmed to survive. What happened with the 34 million ounces going to delivery is not an event. It is a structural alarm. It tells you something inside the plumbing is breaking. Because the real war in this market is not happening on your trading screen. It is happening between vault managers, industrial buyers, clearing members, sovereign actors, and banks that are now being forced to make a decision they never expected to face. Do we deliver the metal, or do we defend the paper? And every suppression event you see as the answer, they are defending the paper, which tells you everything you need to know about what comes next. This is the part no anchor will say on television. The silver market is no longer clearing honestly. It is being held together by continuous emergency intervention. Price is no longer a signal. It is a tool. Liquidity is no longer real. It is rented. And confidence, the only thing that actually keeps this machine alive, is evaporating inside the institutions that matter. That is why this is not a cycle. It is a regime change. Because once physical demand disconnects from paper pricing, the old model dies. The derivatives can no longer anchor reality. The algorithms lose their authority. And the market reverts to something brutally simple. What exists is what matters. If this still feels abstract, good, because the next section turns this into math. What finally exposes every fake market is math. Narratives can lie, charts can be engineered, analysts can spin, but numbers do not care who is on television, and the math in silver right now is screaming. Let's start with the impossible contradiction sitting in front of you. On your screen in New York, silver is hovering around the low 70s. On the ground in Shanghai, industrial buyers are paying the equivalent of $85 to $90 an ounce. In Tokyo's private channels, premiums are pushing implied pricing north of $120, even $130. That is not a spread. That is a fracture. Under normal market conditions, this cannot exist. Here is why. The entire structure of global commodities pricing is built on arbitrage. If silver is cheaper in New York than Shanghai, traders buy in New York, ship to China, and sell into the higher price. That process collapses the difference. That is how price discovery is supposed to work. Except, it isn't working. The arbitrage mechanism has failed. And the only reason arbitrage fails is when the metal is not available to move. Paper says silver is $71. Physical says silver is $90, $120, $130. Which one is real? Let's do the math. If COMEX were functional, traders would be emptying New York vaults, loading ships, and delivering metal into Asia at massive profit. That is the most basic economic incentive in existence. The fact that it is not happening at scale tells you one thing. The metal is not there. Or more precisely, it is there on paper, but it is not there in deliverable reality. This is what the breakdown of arbitrage looks like. You're watching the moment when the world's largest pricing hub becomes irrelevant to the physical trade it claims to represent. That is why Shanghai is leading now. That is why Tokyo is decoupling. That is why Western exchanges are becoming narrative engines instead of price engines. The paper market is still trading contracts. The physical market is trading survival. When you see premiums explode like this, it is the physical side saying, we don't believe your numbers anymore. And when that happens, the paper side loses all authority. Because price without delivery is just a story. Every empire's currency system dies the same way. Not in a crash, but in a disconnection. This is that moment for precious metals. The arbitrage engine is broken. The vaults are bleeding. The industrial side is hoarding. The banks are trapped short. And the public is being shown a chart that no longer represents reality. This is why silver is no longer a commodity. It is becoming unobtainium. This is why nations are scrambling. This is why supply chains are quietly rewriting contracts. This is why delivery volumes are exploding. Because once physical holders stop trusting paper pricing, the repricing is not incremental. It is instant. The moment a major institution says, we don't care what COMEX says, this is the real price, the game ends. When markets start behaving this way, and when price detaches from reality, when delivery stress explodes, when arbitrage collapses, there is only one place to look next, the plumbing. Because no modern financial system fails in public first. It fails in the pipes. And the pipes right now are glowing red. Let's talk about the repo market. You don't hear about it on CNBC. You don't see it in Bloomberg headlines. But this is where the system breathes. Over the last cycle, we have watched emergency liquidity injections appear with increasing frequency. $17 billion here, $34 billion there. Overnight operations, term facilities, collateral swaps. They tell you it's technical. They tell you it's seasonal. They tell you it's routine. That is a lie. Those are secret bailouts. They exist for one reason. Somebody somewhere is about to break. When derivative exposure meets physical shortage, the only way to keep the machine alive is to flood it with cash and substitute collateral. The Fed does not step in because everything is fine. The Fed steps in because something is on the verge of snapping. And this is where silver becomes critical. The largest banks on earth are not just participants in the silver market. They are its architects. They built the paper leverage. They wrote the contracts. They structured the suppression model. And for years it worked because nobody asked for the metal. Now they are asking. And the banks are trapped. This is what I call the blue whale flip. For decades, the major bullion banks have been structurally short silver, selling paper against physical they never intended to deliver, confident that the game would never be tested. But now, quietly, invisibly, that position is changing. Shorts are being covered, exposure is being shifted, long positions are being accumulated through private channels. They are not doing this because they are bullish. They are doing it because they smell systemic risk. This is the same behavior you saw in 2008. Only this time the pressure point is not housing, it is commodities, and silver is the fuse. Behind the scenes, central banks, commercial banks, and clearing members are negotiating reality. What can be delivered, what must be deferred, what can be cash settled, and how long the illusion can be maintained. Every emergency repo operation is a heartbeat of a patient in distress, and silver is the infection. When you understand this, the entire picture changes. This is no longer about investing, it is about survival positioning. Because once the plumbing fails publicly, the repricing is unstoppable. Here we go. Now you see why this is not a market. It's a war zone. And now we reach the part they are most terrified of you understanding. What is driving this crisis is not speculators. It is industry. It is governments. It is supply chains breaking in real time. This is where silver stops being a metal and becomes infrastructure. Because while Wall Street is still trading paper contracts, the real world is consuming silver at a rate the system cannot replace. Look at what is happening in industrial demand. The global auto industry has crossed a line, the shift toward solid-state battery technology. And one of the leading designs under development right now, particularly inside Asia, requires nearly 1 kilogram of silver per vehicle. Not grams, kilograms. Do the math. 10 million vehicles, 10,000 metric tons of silver. There is no mine supply for that. There is no vault buffer for that. There is no paper structure that can fabricate atoms. At the same time, China has begun quietly restricting exports of strategic materials while aggressively accumulating silver and other industrial metals through sovereign channels. This is not trade. This is stockpiling for the next economic order. And while that is happening, the COMEX and private vault system is hemorrhaging metal. Every month you see it. Registered down, eligible down, withdrawals accelerating, deliveries rising. Metal is leaving the building. Not for speculation, for consumption. That is why silver is now being referred to inside defense and technology circles as war metal. Because modern economies do not function without it. Solar, EVs, defense systems, communications, AI infrastructure, medical, energy storage. Silver is in all of it. And unlike paper currency, you cannot print it. This is why I call it unobtainium. Because the moment industry realizes supply is structurally insufficient, the hoarding begins. The moment hoarding begins, price no longer matters. And the moment price no longer matters, the system collapses. This is the physical exit. This is the vault drain. This is the point of no return. The paper market can pretend. The physical world cannot. And when the last easy ounce leaves the vaults, the repricing will not be gradual. It will be violent. Because you cannot negotiate with physics. This is the final phase. This is where everything you've just seen turns into action. And if you understand this part, you do not panic, you position. What comes next is not a crash. It is not a recession. It is not a bear market. It is a monetary regime reset. Every cycle in history ends the same way. The debt grows faster than production. The currency weakens faster than confidence. And the real assets disappear from the public markets. That is where we are now. This is why I keep repeating the phrase, digits to atoms. Because digits are promises. Atoms are reality. And when the system enters the phase we are approaching, where delivery stress, industrial hoarding, and monetary expansion collide, only atoms survive intact. Here is the framework I want you to carry into 2026. I call it the 5 and 200 rule. 5 years of positioning, 200 years of monetary history. Every fiat currency in history eventually returns to its intrinsic value, 0. Every society that survives does so by holding what cannot be printed. Metals, energy, land, production, and infrastructure. This is not about getting rich. This is about staying whole. When paper systems fail, they fail fast. Banks freeze. Capital controls appear. Withdrawals are limited. Contracts are rewritten. And price becomes a political decision. That is why this is the window. Not when the headline hits. Not when the panic starts. Before. This is the final transfer from confidence in institutions to confidence in reality. Silver is not just a trade. It is an exit. An exit from leverage. An exit from promises. An exit from narratives. What you hold physically is outside the system. What you hold on a screen is inside it. When the next phase hits, the people who waited for confirmation will receive it right after the door closes. That is how every reset works. You are not early. You are on time. And if you've made it this far in this breakdown, you already understand. This is not noise. This is the signal. I will see you on the other side. Like, subscribe, and share.